Hey Bowtie Nation, Joseph Hogue here, and loving our Perfect Dividend Portfolio series. It's been some of the most popular videos on the channel. Today, fourth in our series, is easily my favorite because it's going to combine that high dividend yield with an upside price returns, an average return of 38% across the 5 stocks. Now, I'll leave links in the description below to the rest of the series. I'm covering every dividend type and strategy here, from high yield to dividend growth, monthly dividends, and ETFs. In each video, I'll reveal the best dividend stocks for your portfolio, stocks that are going to put cash in your pocket, including the ones in my portfolio. Our first stock here, Hasbro, ticker HAS, pays a 4.5% dividend and just reported a turnaround in its first quarter earnings. Hasbro reported a big boost in digital gaming division, with sales up 12% there, helping to offset some of the decline in products overall. It also maintained its full-year outlook on revenue and profitability, so management is very positive on the second half of the year. That sent shares surging as much as 20%, but it's still 47% off the one-year high, and with some big catalysts coming. Hasbro could benefit from a return to theaters and a strong blockbuster schedule this year and next. This year we've got several Marvel movies, as well as Transformers, both of which Hasbro holds the licensing rights for the toys. Shares trade for just 14 times this year's expected earnings, versus a 5-year average closer to 37 times PE. Now, even if it makes it back to maybe a 20 times PE ratio, and on 2024 earnings of $5 a share, that's a $100 stock price for a 61% return on top of the dividend. We're just getting started on our list, but it can't all be about dividends. If you want to see the stocks I'm buying for the next 30 years, check out the link I'll leave in the description below. It's a free report I put together with the Motley Fool, the 5 stocks I'm buying for 10x growth, my forever stocks. It's totally free. Just click through the link I'll leave below and sign up for your free report. I've been following electric vehicles for a while as one of my favorite megatrends, and think Ford Motor, ticker F, with its double-digit dividend, could be one of the most underestimated winners here. I recently highlighted electric vehicles in a megatrend video, with demand at just 7% of total vehicle sales in the US, but expected as high as 20% as early as 2030. That would be an additional 2.5 million EV cars sold every year by 2030 and 15 million a year by 2050, based on about 17.5 million cars sold in the US alone. Of course, Tesla is still the runaway leader in the space, but Ford is gaining fast, selling over 61,000 EVs last year to become the second largest EV maker in the United States. The company paused its production of F-150 in February, but maintains it can reach 150,000 annual run rate in production and 200,000 run rate for the Mustang Mach-E by the end of the year, tripling last year's production of the F-150. Remember, it was only 2 years ago that shares shot up to $20 each on that investor sentiment for the EV future. While the stock has come down with the rest of the market, shares trade for just 0.3 times on a price-to-sales basis. On expected sales growth to $170 billion through next year and just a modest 0.4 times valuation, we get to at least $17 a share and a 48% upside on the price. Now, we're just getting started on our list of dividend stocks, but why not just go for the highest dividend yields out there? Investors love chasing those highest dividend yields they can find, and it's hard not to get excited about a stock that's going to pay a 20% dividend, 20% yield. That would earn you $1,000 a month in dividends on a portfolio of just $60,000. Now, the problem is when you look closer, you see most of these extremely high dividend stocks have destroyed investor value over the years, with shares crashing, wiping out your portfolio before cutting their dividend. Nation, there is nothing wrong with looking for a higher dividend, but chasing dividend yield alone is a tightrope between high yield and risk, and with some of the highest yielding stocks, you're gonna fall off. You can still reach for those 20% returns, but with a mix of dividends and price. We see here the breakout of dividends and price returns for the S&P 500 since the 1940s. The contribution from dividend return is in blue here, with an average of 42%, almost half the total market return. And when stocks crash, it may be your only source of positive return. But now only focusing on dividends means you could be missing out on the bigger return, the other 58% contribution to total returns from price appreciation. Every single one of the stocks today can produce that 20% plus total annual return over the next few years, but I want to know which you prefer. Would you rather have that higher price return or dividend yield, and why? So let me know below in the comments. And the bank crisis has opened up some great opportunities, and I'm watching US Bancorp, ticker USB, with its 6.3% dividend. The USB lost as much as 42% of its value in the banking crisis, but not only is this the largest regional bank in the United States, but also the fifth largest bank by deposits, with over $570 billion in domestic assets. Now, that size and nationwide exposure gives it the financial strength to not only survive, but to grow its deposit base at the expense of some of the smaller regional banks. USB has always produced some of the best returns in the industry, with a 23% return on tangible common equity, dwarfing the 15% return on Bank of America and even the 20% return on tangible at JP Morgan. The bank has grown the dividend by 10% annually over the last 5 years, and with a payout ratio of just 43%, it can keep up that pace in the future. Our shares of US Bank have fallen along with the rest of the regional banks, but looking at the fundamentals here, this is much more like that large nationwide bank idea. The 90% and higher uninsured deposits that sank Silicon Valley Bank and Signature can be seen here at the top of this chart by Visual Capitalist. Scroll down though, and you see that USB has just 51% of its deposits uninsured, about the same as JP Morgan. Now, that banking crisis is still unfolding, and this stock is touching new multi-year lows, but trades for just 1.2 times book value. That's a steep discount to the average 1.7 times book value over the last 5 years, which means just a return, a revaluation back to that norm would mean a 40% upside on the stock price, along with the dividend. We've still got 2 more total return dividend stocks to watch, but I want to show you how I found these and how to always find the best stocks to buy for that price and yield return. Now, in the past, I've tended to highlight the total return dividend stocks by past performance, always looking for those high yield payers that also produced the higher returns. Looking back on past returns can be a way to find those companies with that superior management and just the competitive advantage over its peers, factors that are going to help them produce those future returns as well, but can also let those past events kind of confound your stock picks. For example, energy stocks have produced both the strongest returns and dividend growth over the last few years on those surging oil prices, but the future is unlikely to be quite as good. So for this video, I'm focusing on the trends that are going to drive earnings growth, then finding the dividend stocks within those that are selling at steep discounts to fair value. They may not be the highest return stocks of the past, but looking forward, they should produce strong appreciation along with those cash returns. To do this, first I'm filtering for stocks paying a dividend yield of at least 3% or more. I want companies with a strong commitment to that shareholder cash return. I'm then looking for growth trends over the next 3 to 5 years and stocks within those with a PE or a PE to growth ratio that leaves room for price upside. We find that double-digit dividend and upside potential here with Chesapeake Energy, ticker CHK, and its 10% dividend yield. Chesapeake is one of the largest natural gas producers with over 6.5 trillion cubic feet of gas in estimated production over the next 5 years and $6 billion in free cash flow. The company has a history of shareholder cash return, paying a variable dividend on top of the base amount. Just on that cash flow estimate, the company is projecting $3.9 billion in dividends through 2027, along with another $4.7 billion in share buybacks and debt reduction. Natural gas prices hit a 14-year record at nearly $9 per million BTU last year, sending shares of Chesapeake up to $103 each before that mild winter just crushed prices now. But the upside here makes natural gas producers one of my favorite long-term investments. The price difference between natural gas in the United States, that green line here at the bottom with Henry Hub prices just over $2 per million BTU, and the price for nat gas in Asia and Europe has exploded over the last few years. The price in Europe touched $60 in 2021 and surged to over $40 last year. Now, until just a couple of years ago, the US had no way of exporting natural gas, and it's still relatively limited at just 14 billion cubic feet per day export capacity. This chart shows the massive growth, though, over the next few years, adding 3.3 billion cubic feet per day in 2024 and another 3.4 billion cubic feet in 2025. Longer-term export facilities are going to be adding another $24 billion in cubic feet export capacity. Natural gas producers are going to make billions of dollars here as that price increases in the U.S. on that additional demand, narrowing that gap between U.S., EU, and Asia gas prices. That's why the average analyst target for shares of Chesapeake is at $115 each, a 47% upside to the current price, and why I think it could continue higher for years. Now here, I don't want to assume that that high dividend yield is completely safe, but instead just know where it might come out, and if I'd be happy with that. Chesapeake is dividend break even at $2.40 on natural gas, just above where prices are right now. Now that quarterly base dividend of $1.37 per share turns out to be about a 7% yield with the additional special dividend from previously higher prices. So even at that rock bottom price on natural gas right now, I think you can still expect at least a solid 7% dividend along with serious price and dividend upside on that long-term theme in natural gas. We're shooting for the biggest returns in this list of dividend stocks, but every portfolio needs a few stocks you can always count on. Check out the video here for the 5 safest dividend stocks. 5 stocks that will never let you down. Another double-digit dividend and big price upside here on shares of Medical Properties Trust, ticker MPW, with its 15% dividend. Now, a lot of you have been following MPW with me, and I'll be first to admit the plunge in price has been nasty. Shares are down 57% just over the last year as the entire real estate investment trust industry gets just rocked by those higher interest rates. Here you can see in the NAREIT data, REITs lost 25% of their value last year and are just barely positive for 2023. Healthcare REITs alone lost 22% last year and 5% just in March as that crisis hits hospital solvency and weighs on the property type. MPW is the second largest owner of hospitals in the world with 442 properties and rare international exposure for a REIT, operating in 34 U.S. states and 9 countries. It's about 60% of the portfolio in the US, but also 22% in the UK and throughout Europe. Now, the company does have some issues with its 2 largest tenants, Steward and Prospect Medical, but is moving in the right direction to protect its cash flow. Steward has agreed to sell 5 Utah hospitals and use the proceeds to pay down a loan from MPW. And MPW has announced a deal to sell its Australian Healthscope portfolio for $800 million to prepay its debt through 2024. Management has already forecast nearly $1.60 per share in funds from operation this year. That easily covers the $1.16 per share dividends. We've started to see some improvement in hospital operations during Q1 with a return to higher margin procedures. That's going to help support financials for their tenants of MPW, and an eventual decrease in the interest rates later on this year is going to help drive those prices higher. Longer term, though, I really like the healthcare segment of that real estate market. We're only getting older here, folks, and that means strong demand for medical services. So despite these near-term issues, there is still a lot of value locked up in MPW's property portfolio. Understand, though, the stock is trading as if there's going to be a dividend cut, and I'm not saying it won't happen. Funds from operations cover the dividend by 138%, but cash flow has been impaired, so I wouldn't want to rule out a short-term cut. What I am saying, and this is what we saw with Chesapeake, is that even if MPW cuts its dividend to 80 cents a share, that would be an FFO coverage ratio of 1.5 times the dividend, back clearly in safety territory, would still represent a 10% dividend yield. I'd be more than happy with that on top of the price appreciation that I think we see over the next few years. At its current price, MPW is trading for just 4.75 times this year's expected funds from operations. That's half the longer-term average of 10 times FFO. Even an increase back to 8 times FFO would mean a $13 stock price and a 71% price upside. Use the link below to get your free report and see my forever stocks, or click on the video to the right for the safest dividend stocks out there. 5 dividend payers that will never let you down. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.